Very good morning to all of you. On behalf of Committee for Members in Practice of Institute of Chartered Accountant of India, in today's VCM on very important topic, direct tax and indirect tax. As we all are aware, the Honorable Finance Minister has just recently gave her budget speech relating to the changes in the direct tax and indirect tax and others in Union Budget 2022. So there are a lot of changes in GST, indirect tax, direct taxation, international taxation. So today we are again here to discuss clause by clause in various intricacies of the budget relating to the direct taxation, international taxation, and GST and indirect taxes. So in order to cater these two important topics, we are having with us two eminent speakers from our own chartered accountant fraternity, CA Gaurav Gupta ji and CA Garima Pandey ji. So on behalf of Committee for Members in Practice of Institute of Chartered Accountant of India, I welcome you, Garima ma'am. Namaste. I welcome you, Gaurav Gupta ji. Welcome to you, sir. And today we are going to cover two important sessions. One on works contract, that is the convolution and legal disputes, various changes in this budget, as well as the recent changes in corporate tax and international taxation in this recent budget. So, in order to cater this technical session relating to the works contract as well as this legal dispute and issues in that, we are having with us CA Gaurav Gupta ji. And relating to the direct taxation and international taxation and recent amendments in the Union Budget, we are having Madam CA Garima Pandey ji. So it is my proud privilege to share with all of you the brief profile of CA Dr. Gaurav Gupta ji and Madam Garima Pandey ji. Advocate Gaurav Gupta ji is a graduate from Shri Ram College of Commerce, Delhi University, and a law graduate from Delhi University. He is a fellow member of Institute of Chartered Accountant of India. He has completed his Masters of Law in 2021 from OP Jindal Global University. He has completed his ISA post-qualification course of Institute of Chartered Accountant of India, and he has obtained his doctorate in taxation from École Supreme Robert D. Sorbonne, University of France. He is practicing as an advocate in Delhi High Court and tax tribunals. He is practicing as an advocate in high courts, especially Delhi High Court, tribunals, and other courts. He has more than 18 years of experience in indirect taxation, and during which he was extensively involved in consulting and litigation of assessors, including multinationals and domestic companies across a range of sectors such as infrastructure, power, education, medical, telecommunication, broadcasting, IT, FMCG, financial services, etc. He specializes in handling enforcement, audit, litigation matters in indirect taxes in India. He has also worked as head of the taxation of listed group and with a Tier 1 consulted firm in indirect tax space and had worked an assignment involving provisions of opinion and consulting to Fortune 500 companies. He is also author of to the books of many titles on GST, including Goods and Service Tax Law and Practice, Handbook of GST Law and Practice, GST Hand Guide for Practitioners, GST Manual, GST Referencer, Service Tax Law and Practice, Service Tax Ready Reckoner. He has contributed to various publications of Indirect Tax Committee of Institute of Chartered Accountant of India and has co-authored compendium on all notifications, circulars, orders, clarification and determination in Delhi Value Added Tax 2004. He is the author of online source of resource of GST, www.gstindiaguide.com. He is a co-opted member of Strategy Planning and Monitoring Group Committee of ICI for the year 2021-22. He is an elected member of Executive Committee of Sales Tax Bar Association Delhi for the financial year 2021-22. He is a founder member and executive member of Society of Tax Analysis and Research, and he has been a special invitee to the Indirect Tax Committee for the year 2012, 2014, 2015, 2018, 2019. He was a co-chairman of Indirect Tax Committee of the Indirect Tax Committee of PhD Chamber of Commerce for financial year 2019 and 20. He was also member of Managing Committee of Indirect Tax Practitioner Association, Chhattisgarh, Raipur, India, and member of Committee of Sales Tax Bar Association 2016, 18, 19. He has been a joint secretary Sales Tax Bar Association for financial year 2014 and ex-senior advisor to the World Association of Small and Medium Enterprises. He is also a member of executive of STBA for the financial year 2021. He has been convener of the Delhi Study Group on GST, Institute of Chartered Accountant of India for 2016, and member of Indirect Tax Committee, ASSOCHAM. He has addressed more than 600 seminars, webinars, virtual CPE meetings on indirect taxes in various forums, seminars, conferences organized by various professional bodies, ICI, ICSI, ICWI, and including the PhD Chamber of Commerce, etc. And he has also delivered various lectures to Sales Tax Bar Association, National Chamber of Commerce and Industry, Southern Gujarat Commercial Tax Bar Association. He is also a faculty of GST and Indirect Tax organized by ICI and GST Commissionerate, etc. During this pandemic, he has delivered so many online lectures, online webinars, and virtual CP meetings. Still, list is very vast. It will take another 5 to 10 minutes to elaborate his profile. So hats off to you, sir, Gauravji. Once again, welcome to you on behalf of CMP of ICI. Welcome, Gauravji. We are having with us Garima Pandey, madam, also. Garima was admitted as a partner in Ernst& Young India tax practice in 2011 and focused on telecom, media, technology, and professional services sector. She is also the national leader of business tax services in India. Garima ji has started her career in 1999 and has been associated with the firm since then. She has over 21 years of vast experience in advertising, advising, and assisting clients on broad range of tax and regulatory services. As far as his functional expertise is concerned, she is expert as well as in the she's delivering his expertise in corporate tax and regulatory advisory, corporate tax compliance, foreign investment consulting, acquisition consulting, transaction structuring, dispute resolution, and litigation support. As far as her professional experience is concerned, Garima has extensive experience in addressing tax and regulatory issues on various aspects of domestic and cross-border transaction, including tax treaty interpretation. Over in the past 21 years, she has supported clients in effectively handling their compliances, tax reporting, and disputes, including implementation of alternate dispute resolution strategies. Garima ji has also assisted various companies in formulating their entry stage in India and from tax and regulatory perspective, including advice on routing of investment in India, maximizing fiscal incentives, and achieving tax efficiencies. So once again, welcome to you, Garima ma'am. And from behalf of CMP of ICI, I extend my heartiest thanks for sparing your valuable time and enlightening of this. So thank you so much, Garima ma'am, for joining us. So let's start our first technical session relating to the indirect taxation and the works contract. And we know the topic is very relevant and very apt relating to this various issues. There are lots of issues, lots of litigation issues, legal issues, and issues involved in this. So we have with us eminent speaker, eminent chartered accountant, eminent advocate Gaurav Gupta ji. So without wasting much more time, I request Gaurav ji to please deliberate and share your experiences. Over to Gaurav ji, please.
Thank you, Lalji. Respected in absentia CA Dr. Sanjeev Kumar Singhal ji, Chairman Committee for Member in Practice, respected Vice Chairman in absentia CA Prasanna Kumar ji, the Secretariat, Lal Sahab specially, my very learned co-speaker Garima ji, all the members joining today's VCM, a very good morning to all of you. Friends, a topic which has been chosen very specifically by the committee. When we were discussing the topic which I suggested was primarily on account of the changes in ITC. But I think a lot of budget seminars have already taken place, and see, this is the vision of a committee that they said that this has already been spoken much on. So let's take up a topic which will be a bit of a different flavor to the members, because we want to enrich the deliberation and discussion with the members. So my dear friends, I'm taking on a topic which is not new to India. It has been a matter of debate since the very inception of indirect taxes in India. What is works contract? What is the taxability of works contract? What are the different issues we see in works contract? There are certain predicaments, there are certain issues, there are certain precautions which we need to take. Let us discuss one by one. I'll not discuss on the history part of it, what had been in the VAT days, what had been in the service tax days. I'll only touch upon whenever it is necessary to do so, because I am fully aware that all my learned members, number one, they know the past, they know the history. Number two, they are also very much interested what lies ahead, because the GST audits and the GST inquiries have started. And I can tell you, in classification, works contract will be one of the biggest pain areas we are going to see in the coming days. So my dear friend, to begin with, what is works contract? Now that's a very simple question which we have been struggling with for a long time. Cone elevators have already been debated a lot. Honorable Supreme Court 5-member bench, this particular decision has been, I would say, held by the Honorable Supreme Court 3 times, and every time a larger bench was overturning the decision of the previous bench. So finally, we got onto, I'm talking about the VAT times, we got onto a situation where we had been given a definition, we had been given an understanding of works contract in the past. But however, my dear friend, the definition which has been used by the statutes in past has altogether changed now. So with this first understanding that please do not borrow the concept of works contract in entirety from the past. You have a very substantial difference in past and the present. That's the first thing which I would want to put before you. Second, we have a clear understanding of pure supply of service or pure supply of goods. If I'm selling you a television, it's a pure supply of goods. Everybody is very clear. Okay, we'll charge the tax which is applicable on goods. If I speak about, I'm supplying you a services of chartered accountant services, you are very clear. It is again a service which will be exigible to GST at the rate of 18%, and there is no iota of doubt on it. Now, when we enter into a regime where there is a mix, I'm very cautiously using this word mix, because this particular term is having very varied versions, very varied variants. This particular mix puts the entire debate into a zone where one becomes, when things get confused, and one may become a victim of a wrong classification. So let me just put up some cases before you. Number one, I am selling you a television where I'm also have to install the television at your home. Simple case. Number two, I am undertaking a contract to paint your entire home or your office. Number three, I have undertaken a contract to clean all the oil tanks of Indian Oil in a particular state. Now that particular tanks, I have to use certain chemicals, because without those particular chemicals, I cannot clean, and these are very specialized chemicals. I might be spending 10,000 rupees on the chemical per tank, and the labor will be my minimal, maybe 1,000 rupees. Number four, the fourth category of contract, I have taken a contract of construction of a particular building from you. Now, my dear friend, all these four have a mix of goods and services. Let us speak about one by one. Before we discuss what is the mix, let me first lay down the foundation, the fundamental on which the entire works contract is based. In fundamental, works contract is a service, is a supply of service, and during that particular provision of service, there is a transfer of property in goods. Now, that's a fundamental which has been accepted across board, across all court decisions. It is not vice versa that the courts have said that there will be a mix of goods and services. No, sir. There has to be a provision of service, and during that particular provision of service, there will be a transfer of property in goods, and that is where the works contract will exist. So in my first case, when I'm supplying a television to you, the television installation is not the primary or the principal contract. Now here, a particular concept, what we call the dominant intention, comes into play. Whether I'm wanting to have the services, whether I'm wanting to have the goods, or whether I want to have a service where I need a transfer of goods also. That is the first thing which I'm looking. I know there will be difference of opinion in this particular debate, whether the dominant intention still lives, because after the cone elevators, the dominance in terms of what is the value, what is the pricing of goods vis-a-vis services in a contract to determine whether it is a works contract is no more. But I'm not saying the pricing dominance. I'm talking about the intention, the intent, whether I'm wanting to have a principal service or whether I'm wanting to have a principal goods, or is it goods which will come to me during the provision of service. Now, what is the difference between having principal goods and goods during the provision of service? In the case of former, the supply will be that of goods, and there will be an incidental service which will accompany that particular goods. For example, in case of a gift, you might, in case of giving some gift, a watch to your brother, you might be needing a gift wrapping. Now, that particular gift wrapping is not the principal supply, not the intent. The intent is to buy a watch. It is merely an incidental service, so that will also be accompanied. Similarly, if you are wanting certain goods to be transported, similarly, if the goods are to be transported, after that, it has to be just placed or installed simply, which is not a very skillful work, or which is not the intent to get those particular services. But there will be goods where the service of installation is very complicated and not every person can do it. So the intent also shift. No, I'm very particular that this particular company should install it. Now, when the particularity of installation also comes in that particular case, the contract will somewhere be tilted towards the zone of a works contract. Now, I'm talking about the concept of works contract in a broad sense. I have not yet arrived at the concept of works contract as encapsulated in the GST statute as on date. So, my dear friend, the first thing which I'm wanting everybody to understand, that there will be certain supplies or certain goods which will be supplied in addition to the principal supply, which are incidental and not a particular, primarily intended to be taken by the buyer. In those particular cases, it will not go into the zone of mix of goods and services towards works contract. Second case, where I was speaking about the supply, where I have been given a contract to paint the home or paint a building. Now, my dear friend, in this particular case, is the skill involved? Are you wanting the painter to do it, or any other person can do it? No, sir. You are wanting a painter to do it. It's a skillful job. So the service intent is the primary intent. And then comes that during that particular provision of service, there has to be a transfer of property in goods in the form of paint, which will be applied on your walls. Now, in this particular case, the value of paint may be 10,000, the value of services may be 5,000. Immaterial of that, it will be a works contract, because service along with transfer of property in goods is happening. Number 3, I was talking about the contract where there was a cleansing of the tanks of Indian oil, which I have taken for a particular state, where there are very sophisticated, complicated, or whatever term you may use. Specialized chemicals is a specific term which we use. Those chemicals are required because those particular tanks cannot be cleaned with pure water or normal cleansing detergents or whatever. Now, my dear friends, in this particular case, the consumables, the goods are not accredited. The goods are not passed on. The goods are not transferred. The property in those goods are not given to the buyer. The goods are simply consumed in performance of a service. They are extinguished. The property is not transferred. And since the property is not transferred, it will definitely be falling within the ambit of performance of service. My example also stated that the value of goods in this particular case, the chemicals will be 10,000, which will be required to cleanse a particular tank. And the services which will be required will be of value 1,000 as a supplier. Still, please do not be guided by the value of goods or services. The company, the contractee, does not want the chemicals from you. He could have procured it in a better manner than what you are supplying. It is not a contract or a purchase order for supply of goods. It's a requirement for cleaning of tanks. So, my dear friends, anything which is consumed during the provision of service and where the goods are not applied and left over on the property of the buyer or the contractee, in that particular case, it will not be a case of works contract. It will be simply a case of services. Pest Control of India, very celebrated judgment, very nicely written. I would say this is one of the landmark judgments we have on this concept. Moving further, if I give you another complication in this particular case, that I have to apply certain chemicals where those chemicals will be accredited or stuck to the walls of that particular tank, and they will be left over, and they act as a protector of those particular layers of the walls of the tank. In this particular case, my dear friend, the goods are not consumable. They are being left over. The property is getting accredited to the property of the buyer. And therefore, in this particular case, the moment that particular product sticks, it will come into the ambit of a works contract. There is a service and there is a passage of property during the provision of service. It is immaterial whether out of that 10,000, merely 1,000 rupees of goods are left over on the walls of the tanks as a protection layer. Value is immaterial. That is where Honorable Supreme Court in the landmark decision of Cone Elevators, the basic principle which was laid down, that please do not be guided by the value. If it is a skill required for the performance of the contract accompanied by the transfer of property during the provision of that particular work, it will be a works contract. Now, coming on to the fourth case, construction of a building. My dear friend, construction of a building, there can be multiple categories of contracts. You have given me a contract for construction whereby the material is to be provided by you. Now, what I am doing is only a labor contract for construction. It is a pure supply of services. Similarly, there may be a contract where I'm also a supplier of goods. So you will be buying material from me and have also given me a labor contract for construction. These are two distinguished, two separate contracts. It will also be falling into the zone of a supply of goods and supply of services. So what is the difference then? My dear friends, the supply of goods, the property transfers there and then once the goods are handed over. Now that is a very trite concept in case of movable properties. Once you hand over the property and goods will transfer to the person who is taking the possession of those particular goods, if the title of the goods are non-challengeable, they are correct. Now, in this particular case, my dear friend, the property has transferred. Tomorrow, if the goods are damaged, the supplier of services is not liable. The loss will be borne by the contractee. However, in the third case, if I am giving you a contract to construct a building using your material also, even though I'm specifying the quantum, BOQ, the quality of the goods, even then, since the passage of the property is happening during the provision of service, it will be a works contract. It will not be a divisible contract. Now, that is where the word divisible comes in. My dear friends, you have to understand that this is, when you speak about works contract, it is one entire indivisible contract. Refer to the very celebrated judgment of State of Madras versus Gannon Drunkle and Company, 9 STC by 533. This is the core point where you have to look whether the contract is the divisible one or an indivisible one. If it is a divisible one, it may be falling into the ambit of supply of goods and supply of services. The moment it becomes one entire indivisible contract, it will fall within the ambit of works contract. Now, there may be friends who will be excited to break the contract in order to get the benefit of higher rate of taxes or pass higher rate of taxes on certain goods or services, or vice versa. There may be a saving in taxes also. There may be a higher tax which may be there. In either case, the choice is not in terms of merely invoicing, my dear friends. You have to see what is the contract all about. If the contract was so awarded that there will be a supply of service during which there will be passage of property and goods, then it is an indivisible contract. You cannot just by writing the prices or the values of those two particular works and supplies separately, you cannot artificially, now underline this word artificially, bifurcate that particular contract into two divisible contracts. So the property, when you are talking about passage of property in case of a works contract vis-a-vis sale, in case of sale, the property will be passed on to the buyer merely by handing over or by physical possession or by construed possession also. So if my goods are stored into a warehouse, I might give you an endorsement on the warehouse slip. Now that particular property has not passed physically to you, but by way of an endorsement, the construed transfer of property has happened. The effective possession has moved from me to you. However, in case of works contract, it is not the physical handing over the property or not even the effective possession of the property which is being handed over. It is basically in form of accretion. When the movable goods are embedded in an immovable property, that is where we will say that this particular works contract has happened. In case of movable goods, there can be two categories of passage of properties in a works contract. Now I'm talking about works contract not from GST perspective. It is the works contract as a concept. So in case of movable goods, the works contract can happen in the form of accession or blending. So by accession, you may attach movable property to another movable property. For example, putting a battery into a vehicle, or for that matter, doing a soldering. In case of blending, you mix the goods of the contractee with few more goods. So I have given you certain goods. I have given you a particular chemical to make a composition mix. In this particular case, the property is getting passed by way of blending into the movable goods. Now, I can speak on this concept on and on. There are a number of complexities, but now it is time that we divide. We now move on to GST to understand that when we speak about works contract in GST, how is it different from the works contract in the earlier era? The fundamental difference which has been brought in works contract is the exclusion of the works contract relatable to movable property. So I can do, as I already spoke, in case of immovable property, it will be by way of accretion. And in case of movable property, the works contract can be by way of accession or by way of blending. Now, my dear friend, the letter is not considered as a works contract from the perspective of GST. For the very simple reason, the definition which has been provided to us in GST in section 2 subsection 119 of the CGST Act is limited only for immovable property. It does not encompass the inclusion of movable property within its ambit. Now, one more important point which you all have to, I am just reminding you, you all know it. Everyone is aware of Article 366(29)(a) of Constitution. What is that, sir? That is a deemed sale. When we were speaking about VAT days, or for that matter, sale tax day, after the very celebrated judgment of Gannon Drunkle 1958. What is works contract? Chattel qua chattel. These are the terms which you have heard in those particular contract. An indivisible contract cannot be vivisected for the purpose of levy of sale tax, artificially bifurcated. No, sir, you cannot do it. It has to be a chattel qua chattel. That is called the sale of goods on which the Constitution allow you to levy a tax. Now, supply is a wider term than sale. When the court was deciphering sale of goods, we were not talking about supply in those days. Supply is a wider term. Supply is for both goods and services, and therefore works contract comes within the purview of the word supply. So when the Constitution talks about GST, it says on the supply of goods and services. Now, here I'm just putting a small remark for everyone to think about. In Gannon Drunkle, the Honorable Supreme Court was speaking about sale of goods, and it said that it cannot it cannot go beyond the natural meaning which has been given to the word sale, and therefore there cannot be an artificial inclusion in this particular term unless very specifically provided by the Constitution, because the power conferred by the Constitution is to tax the sale of goods. Similarly, in GST, the Constitution has allowed the taxation of supply. My dear friends, the supply, whether it includes the supply to oneself, is a big question. Does Schedule 1 is within the ambit of the powers conferred to the government by the Constitution? That is one thing which, in my humble opinion, like Gannon Drunkle in the erstwhile period, this one challenge will also be coming before all of us and the honorable courts, which sooner or later decide this issue, whether the supply term is wide enough to cover the supply to oneself or without consideration as deemed in Schedule 1 of the CGST Act. So, not being my topic today, let me put a full stop to this particular point. Coming back, works contract on movable goods, on immovable goods, movable goods works contract is not there. Works contract on immovable property is the works contract covered under the GST statute. However, when we talk about works contract, Schedule 2, which describes the classification, which provides a classification. It says that works contract will be deemed to be a service. My dear friend, now again a contradiction has come up. Why the contradiction has come up? We still have an article 366(29)A which lives in the constitution when I was speaking about it. It says tax on income includes a tax in the nature of excess profit. And 29A says tax on sale of goods or purchase includes a tax on transfer of property in goods invoked in the execution of works contract. Now, as per the constitution, as we understand, as we have lived this particular article for so many years, it is a deemed sale. It is a deemed sale for the purpose of levy of tax. But my CGST Act says works contract in entirety as an indivisible contract will be a contract of services, and therefore it will be guided for all purposes of rates, value, point of tax, place of tax. Everything will be guided as it is a service, and no element of goods in that particular supply is construed for the purpose of GST Act. Now, your constitution still lives with Article 366(29)A. Your act does not give that particular bifurcation, and therefore this particular contradiction, whether is or, simply to put it, to the extent of 366(29)A does the element of sale of goods involved in works contract should still be taxed at the rates of the goods, or should it be construed as a service as provided in Schedule 2 of CGST Act? I hope I am able to make out this particular fine distinction before everyone. Now, this is again something which will come up as a test in the coming times, that can this definition be seen as an independent, because we are no longer talking about sale of goods or deemed sale of goods. We are talking about the term supply. Now, supply, the way it has been defined, also is dependent on the term sale as one of the 8 categories of supplies which has been provided in the statute. So when we are speaking that supply includes all form of supply like sale. Now, in this particular case, sale still lives, and if sale still lives, then deemed sale will also be a live concept for all of us today as well. Now, in this particular case, 366(29)A will definitely pose a big challenge before the tax authorities, that can they tax the entire contract at 18% when there is still a deeming fiction provided in the constitution which has not been restricted or deleted to this particular extent. So this controversy again will be beneficial to those people where the value or the tax rate of goods is lower, and they want to get that particular element taxed at a lower rate when compared to the entire contract as one indivisible contract which may be taxable at a higher value. A person who is having vice versa, I am very sure he will not be interested in getting this particular kind of a treatment evoking Article 366(29)A. Now, having spoken on Article 366(29)A, now it is time that we discuss or we look into the definition which has been provided for 2 terms. One is job work, which has been provided in Section 2, subsection 68 of the CGST Act, and number 2, Section 2, subsection 119, which is defines works contract. Why I'm putting the definition of job work also at this place is because job work, when we see, will be something which includes the works contract of movable property. How is job work defined in 268? Job work means any treatment or process undertaken by a person on goods belonging to another registered person, and the expression job work shall be construed accordingly. So if I am accessing or I am mixing, blending, so that the property passes on to the other person into the supplied goods of that particular person, which are movable property, then it will be construed as a job work. My dear friends, please understand, in the previous era, prior to 1st of July 2017, this was also works contract. But post 1st of July 2017, it will be covered within the definition of the term job work. Now, the only thing which we are finding a bit of a challenge is it is limited to another registered person. And therefore, one of the entries in in the notification number 11 by 2017 was specifically brought in for tailoring services. Why for tailoring services? Because Gaurav Gupta, when he wants a suit made for himself, he is not acting in a registered person capacity. It is a item of a personal consumption, maybe used for his own personal functions, maybe daily use, whatever. So it is not always an official purpose that he will be needing a blazer, he will be needing a piece of garment. He will be taking that particular supplier of tailor services, giving him the cloth from which he wants that particular suit, blazer, or whatever made. In this particular case, everything in the definition of job work is satisfied. Job work means any treatment or process undertaken by a person on goods belonging to another registered person, and the expression job work shall be construed accordingly. The only trouble is another registered person, where I fail to be a registered person for the purpose of that particular transaction. So they introduced a lower rate separately. So not every job, every kind of works contract will fall in the definition of job work. Primarily those works contract where the recipient who is giving the goods to the supplier for the process or treatment or other works is a unregistered person. Right, sir? Let me not deliberate on this further. Job work itself is a full-fledged topic. Let me come to works contract, which has been provided in section 2, subsection 119. Works contract means a contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration, or commissioning. 14 categories of activities have been provided in the definition of works contract. It means, so works contract means a contract for, out of these 14 activities, of any immovable property, wherein, now very specifically, the activity has to be performed on an immovable property, wherein transfer of property in goods, whether as goods or in some other form, is involved in the execution of such contract. Now, my dear friends, the contract should be such that the property passes during the performance of the contract. Now, please understand and note, this is very, very sensitive. The quantum of passage of property is not determining works contract. So it, out of a 10 lakh rupee contract, the total passage of property may be, let me say, as low as 20,000, but there has to be a passage of property. If that is there, it will become a works contract. The example which I gave you was the lining which is left over on the, which is required to be left over. Now, please allow me to amend my statement, which is required to be left over on the walls of those Indian oil tanks. That particular contract, out of the 10 lakh rupees, even if 20,000 rupee of chemical is to be left over, it is a specific requirement of passage of transfer of property during the cleansing. And let me say, it is basically it is basically an accession on the layer on the walls of the tank, and therefore it will fall within the ambit of the works contract. Works contract is never guided by the values. It is a concept where the requirement specifically should be that of the transfer of property and goods during an execution of service of any immovable property. Now, please also appreciate the goods, whether as goods or in some other form. So if they are not even left as the goods which were primarily being taken, they may be there in any other form. They should not be retained in their own original state. They can take any kind of shape. That particular passage of property is also covered within the ambit of works contract. Let me give you some examples. I have already spoken on the paint which is being applied. You have engaged a painter, works contract. You have engaged a person for repairing the almirah, where the goods, like even small goods like the nails or the clips, are being used by the carpenter and will be procured by the carpenter and be applied, accredited for the performance of that particular work. It will be a works contract. Even a small item like Fevicol, sir, it is a goods which will, the property of which will be passed during the performance. So if I'm talking about a wall paneling where you have given the entire contract, now challenge comes when part of the goods are given by you, part of the goods are given by the contractee. contractor, sorry. The government has always tried to address this situation. Reason so, there may be scenarios where the high tax items are procured by the contractee and given to the contractor in order to save certain amount of tax. In my humble opinion, we will not be guided by what is the value of tax being saved or applied by either part. What we will be guided will be whether there is a transfer of property happening during a works contract and the scope of the works contract to be executed by the contractor. If certain goods are not within the scope of the contractor, that will not call upon. Now, this is something which Bhayana Builders, we all know, Honorable Supreme Court has already held in that particular case. The deeming value addition of the goods which have been supplied by the contractee is not allowed to be added to the value of the contract, taxable value of the contract on which GST is to be paid. Now, that was a case which was there in the service tax era, but in my humble opinion, to this extent, the case is very much applicable. Today also, there will not be a deeming application. Deeming application to the value is only allowed in section 15, subsection 4. When you speak about 15 subsection 4, they are talking about two scenarios. Number one, when the parties are related. Number two, when there is a consideration which is received other than by money. Apart from these two cases, there cannot be an artificial application enhancement of the value because you cannot trigger the deeming addition clauses or deeming determination of value clauses as provided in rules 28 to 33. So, my dear friends, I hope on this point of supply of goods from the contractee to the contractor, I have just shared my humble view. I understand this is again a matter of debate, and my learned friends and my learned experts, co-speakers, might share a different view on this particular point. Now, what are the different kinds of works contract when we speak about? I've given you 2-3 examples. Let me expand my examples a bit more. Transmission lines setting up of substation, works contract, EMC Limited. I'm taking these examples where I find that I am in line with the rulings of the learned authority for advanced ruling. Though I'm not a big fan of decisions of authority for advanced ruling for the very simple reason. They are not a judicial body. They are an authority. They have been specifically set up for a specific work of determining for a assessee. They will not lay down the principles for the entire state or the country as courts do. So, my dear friends, even though they are not applicable, these decisions are not applicable to you, you should read them so that you are able to understand what are the reasoning the other side, the department is giving to tax or not to tax a particular transaction or to adopt a value, place of supply or whatever. In those particular cases, while we are not looking for the law, we are looking for the pointers which may lead to the formulation of the law tomorrow. So please do not look at it as a futile exercise. It's a very, very important exercise. You are trying to prepone the debates of tomorrow to today, and you're saving a lot of interest. So this authority saves a lot of interest for the SSC. You are in doubt, start your fight with the department today. Because tomorrow when the department will undertake the audit, it is already 3 or 4 years which have gone. And in an interest of 18% for 3-4 years plus a penalty of 10%, it is as good as the total amount of tax, my dear friends. So in case you are in doubt, this authority will act as a savior for look it from that perspective. So when I look at those decisions, I'll speak about transmission, tower erection and supply, again a works contract. We talk about supply of fitting, commissioning of air conditioner, designing, fitting, commissioning of air conditioner. Now, we are talking about HVACs. We are not talking about, sorry, a simple work air conditioner which is supplied to you and you have installed the same. So in this particular case, kindly expand the horizon. It will be again a works contract. Very interestingly, CCTV based surveillance system. So what you are doing, your contractor is merely putting some cameras at certain place, wiring them using a simple wire and connecting them to a main hub, whereby you can see the output and recording might also take place. Now in this entire system, the The beauty of the contract is that none of the individual components are being installed. It is a complete system which is being installed. And I can tell you there are a lot of systems like that, mainly when you talk about very sophisticated equipments, let's say in railways, when you speak about even the traffic light system, all of them are not individual components working. They are a set of equipments installed and integrated, and their integrated functioning gives you a system which is useful and which is the entire intent of that particular buyer or the recipient. Again, turnkey project for windmill, erection commissioning of data center, all of them are relatable to immovable property falling within the purview of works contract. Now, my dear friends, we have understood the definition of the term works contract. We have 3 or 4 very, very important questions which come up. Number 1, does the works contractor need to obtain registration in every state where he's undertaking a works contract? Now, this is one question which is, I think, omnipresent. I'm sharing my humble opinion on the topic. I know, again, it is a debatable topic, but my dear friend, please understand, you have to look for the logic. Section 12, subsection 3, it provides for place of supply, right? Section 13 provides for place of supply of services. In both the cases, 12 and 13, place of supply of services in case of domestic and international transactions are being spoken. I'm talking on a very broad sense. When either both the recipient and the supplier in India, either of them is outside India, that is the distinction between 12.2 and 12.3. The point where the immovable property exists is the point where the place of supply exists. So your performance will be at that particular place. Your place of supply, meaning thereby where the taxes will travel. Again, IGST is the tax which ensures that the taxpayer, the registered person, is not supposed to travel to all the state. It is the mechanism by which allows the taxpayer to rest at one place and taxes will travel. So if I'm wanting to pay the taxes in West Bengal, I'll apply IGST and the taxes will go and sit in West Bengal. C plus W will be divided in the state of West Bengal. Now, had I had this facility not been there, I would have been required to filter the challan of CGST and West Bengal GST. And therefore, my jurisdiction of that particular officer might also have been triggered. Now, it is not the case. I'm registered in Delhi. The officer in West Bengal does not have a jurisdiction on me. My Delhi authority will have a jurisdiction to audit, to inquire, to scrutinize whether the correct taxes have been paid by me or not. Now, I am a works contractor. I am supposed to undertake the construction of the building in 5 states. I am located based out of Maharashtra, Mumbai, let us say. Now, I'll give you a very simple case first. I am only undertaking a contract for supply of services. I'm providing labor. My labor will be stationed in that particular state. Am I required to get myself registered? The answer will be no. Though I am giving you an absolute answer, I will just reach on to the conclusion where you will agree in terms of why my understanding is like that. Second, I am a works contractor where I have a divided contract. I'll first supply the goods to the contractee. So all the goods will travel. The contractee will take the possession and become the owner of the goods, and those goods will be given back to me for application to construct a building. I am now a contractor for supply of goods and supply of services. In this particular case also, my dear friend, the answer will, in my humble opinion, will be no. Coming on to the third case, where I am given a responsibility to undertake a works contract of a building, and I will be required to provide the goods or supply the goods which will be used in the execution of that particular construction or accreditation, whatever the case may be. This is the last question. I think we are already on 12:22. So I'll take another, Lalsa, I'll take another 7 minutes to close this concept, and then we will take up the questions. So this particular case, I am now taking the goods to that particular location. I am storing those goods there under my custody, because once the custody pass and the ownership also transferred, we are not about a works contract. Here I will be taking the custody of those particular goods, keeping them on site under my custody. And therefore, my dear friend, there is where a definition of place of supply needs an examination. Section 2, subsection 85. What does it say? Place of supply includes A place from where the business is ordinarily carried on, and includes, mark the words, a warehouse, a godown, or any other place where a taxable person stores his goods, supplies, or receives goods or services, or both. Now, my dear friend, the moment you are talking about goods, it's not services, that there is a deeming fiction that these services are received by the person at his registered location. In this particular case, the goods are physically moving from one unit to another unit, one establishment to another establishment, and therefore where the actual goods are stored, the taxable person becomes or is having a place of business. Now you, by virtue of 285, you are having a place of business. Now the person is liable to get himself registered if he is undertaking the supply of goods or services from a place of business. Now, in this particular case, my dear friend, when I am applying those goods from that particular site onto the property of the buyer, in my humble opinion, there is a passage or there is a supply which is happening from that particular location, even though at that particular location, but the property transfers to the buyer at that particular location, registration required. In very simple terms, till the point you are not storing the goods on site, which are in your custody, you are not undertaking or you're not performing a storage which will trigger a registration for you. The moment you store the goods at the site, the very requirement of registration will trigger, because you have constituted a place of business in that particular location. You are supposed to keep a track of goods received, stored, applied, and the closing balance thereof. So all those requirements will trigger onto you. I am also cautious of the fact that there are many suppliers. This question has come up for a number of times before me. I am using a warehouse person. The warehouse person is storing goods. I'm not storing goods. I don't have a business. Do I need registration there, sir? Since the goods which are being stored are yours, what the other person is giving you is the facility. He's giving, rather than a renting, he's giving you a warehouse facility. In that particular case also, you are supposed to register, since you are storing and supplying goods from that particular place. So either your registration should be there, or there should be someone who is acting as a consignment agent, CNF agent, who is undertaking a registration where the property for the purpose of GST Schedule 1 at least transfers to you. So please be very, very careful when we are speaking about works contract, from the very concept of what is a works contract, the divisibility, the guidance of the entire contract, taxability of the entire contract, to the requirement of registration. I think with the kind of time I have today, I am only able to cover this much of the works contract. Topic is endless. As a speaker, my greed, my intent to speak on this topic is also endless. I love, this is one of the most fondly deliberated topic across indirect tax experts. It is always a learning. I thank committee for giving me this particular opportunity to share my views on certain issues, intricacies on works contract with all the members. If Lal sir, we can take up some questions. It is already 12:27, so that I don't infringe on the timelines.
Yes, sir. There are a few questions, sir.
Please, sir.
The first question is how to bifurcate sales where labor and material both include and unable to measure the accounting level.
I'm not sure what exactly is the question, for the very simple reason, if it is a works contract, why do you want to bifurcate? Will be a single indivisible contract. Even though the contradiction with Article 366(29)A exists, till the law is settled by one of the honorable courts, please take it as one single indivisible contract. That indivisible contract is a contract of service, and the rate of service as provided in notification number 11/2017 under the HSN. Now, please also note, works contract will be under HSN 9954. So you have to look on to the very specific rate provided or applicable to your supply of services of works contract under 9954 in notification number 11/2017 as amended from time to time. Look out for that rate apply. If no rate specified, 18% is applicable. Don't go for distinct value of it. One of the topics which I was wanting to take up is the movement of goods in execution of a works contract, the documentation requirement, how to raise the invoices. I think looking into the positive will take it up sometime, or I can share some write-up with the members through the committee.
Sure, sir. Sure, sir. Sure. So if a contract is comprehensive for property maintenance as a whole, but the rate of each item are different and supplies are in multiple instances, in such case, whether tax rate can be 18% as a main contract is single or maintain the whole property?
See, I have undertaken a contract of maintenance not to supply you a bulb or for that matter the cleansing material or for that matter keeping the lift in a working state. It's a comprehensive contract. You may require a replacement, you may not require a replacement. There will be certain activities which are must to be undertaken. Since it is a single indivisible contract and not supply of individual elements of a particular set of services, it will be taken as a works contract.
Yes. Moving on to another question, sir. If tankers are movable, then whether work done on a tanker and the material left on lining of the tanker shall still be covered under the definition of works contract under GST?
See, it's a very, very nice question, because then we are talking about the test of immovability. Again, paucity of time did not allow me to speak on the immovability. There are 4 categories of tests you need to undertake to determine whether it is an immovable property or not. What you have asked is relatable to the first test of immovability, which is called the affixation to earth test of movability. Yes. And in this particular case, I can tell you it was a very, I'll refer 2 judgments for you. One was in the case of solid and correct engineering works, which was in Honorable Supreme Court. That was 252 ELT 481. The structures were fixed so that the machines can become functional. Now, they are not supposed to be fixed to the earth, but they were just bolted to the earth so that they become functional, and therefore they were held as not an immovable property. On the contrary, you have the decision of Indian Oil, where the large tanks were, even though they are not bolted, but they were supposed to be as a matter. Now we are talking about the second test, which is the test of permanency in immovable property. In the case of municipal corporation versus Indian Oil Corporation, the permanency test was done by the Honorable Court, and it was held that tanks, though are resting on the earth on their own weight without being fixed, they are permanently so have been erected at that particular place and are not supposed to be shifted. So because of the effect of the permanency test, it was held to be an immovable property. So 4 tests of immovability, which test is to be applied? You have to see. And I can tell you all the 4 tests sooner, in one way or the other, will help you in deciding whether something is immovable property or not.
Yes, sir. So what about a particular contract falls under the category of works contract in case the contractor reimburses the cost of material used incidental to performance of service, whether the contractee obtains invoice of the goods used on contract?
My dear friend, the word reimburse has to be very sensitively used and considered in a contract. Let me put my contract very clearly before you. There can be 2 categories of contract. The procurement of the material is the responsibility of the contractor, and the contractee will help in the procurement of those particular goods. And the entire cost and the privity of that particular contract of procurement will be between the contractor and the supplier. And the contractee will merely be facilitating the procurement, will be paying on behalf, which will be reimbursed by the contractor. It is a case of reimbursement. I give you category 2. The contractor and the contractee hereby agrees that the contractee will procure the material which will be applied in the construction of the building, and the entire cost of the goods will be reimbursed to the contractor by the contractee apart from the value of construction of rupees 1 crore. Now, in this particular case, the reimbursement is not actually a reimbursement, but is only a matter of how you pay. So what you have done is you have fixed a 1 crore rupees plus cost of material as a total value of contract. In this particular case, my dear friend, it is not a case of reimbursement. On the entire value of goods plus 1 crore, you are supposed to pay 18%. While in the first earlier case, the invoices would have been in the name of the contractee, and the contractor will only be acting as merely a conduit to pay. That is reimbursement. So use this word reimbursement very, very cautiously.
So thank you so much, sir. These were the questions relating to this deliberation, and we have gained a lot through your deliberation on this works contract. And on behalf of Committee for Members in Practice, I extend my heartiest thanks for sparing your valuable time and giving us your kind consent on a very shorter notice to deliberate on this topic. Today was the 99th CP program of CMP of ICA for the year 21-22. This was the 99th program, sir. We have conducted for the members at large. So thank you so much for joining us today and sparing your valuable time. Thank you so much.
Congratulations to all the committee members. Lal sir, thanks to you. You have been an untiring, I would say, the backbone of the entire committee this year. And yes, with the esteemed guidance, what we have from the chairman, vice chairman, yes, it is always my pleasure to share whatever I have with the members. Thank you, sir.
Thank you so much, sir. Thank you so much, sir. Thank you. Moving towards our next technical session relating to the changes in budget in direct taxation and international taxation. We are having with us from our Chartered Accountant fraternity, Madam CA Garima Pandeji. So without wasting much more time, I request Madam Garima ji to please enlighten with your experiences and share your experiences with all our members relating to the recent changes in direct taxation and international taxation as advised in the Union Budget 2022. Over to Garima, ma'am, please.
Thank you, Lalji, and very good afternoon to all the participants today. So what we'll do, what I thought we will do is cover two parts. One on the international tax, something which has been very recently announced by the CBDT by virtue of a circular which has been issued with respect to the government's point of view on the most favored nation clause, which is a very relevant development which happened only this week, and then cover some of the relevant changes from a corporate income tax point of view, which came in from a finance budget point of view for FY 2022. So I'll start with the recent clarification, but before I start, I think it's important to first understand what has been the background behind the entire controversy on introduction of the most favored nation clause. Just wanted to check, Lal Sahab, are you able to see the slides? Because it's important that...
Not yet, ma'am. Not yet. Not yet.
Okay. So I'll just try again. But, as I was mentioning that, the history on this entire topic involving most favored nation clause relates to dividends which companies are repatriating from India to their foreign parents or non-residents, which are tax residents of some specific countries.
It's visible now.
Perfect. Thank you. Now, when we look at the history of Finance Act 2020, the traditional dividend distribution tax-based regime was done away with, and dividend income was considered taxable in the hands of the shareholders. Now, this brought in the point that any dividend that an Indian company is repatriating to foreign companies, that becomes taxable in the hands of the foreign shareholders. Now, there are certain tax treaties which provide for a beneficial rate for taxation of dividends, which they receive from Indian companies. Now, interestingly, there are certain tax treaties which, while they provide for, let's say, a rate of 15% or 10%, also have a very unique clause. And when I say a unique clause, it is called the Most Favored Nation clause. Now, this clause provides that if after signature or entry into force of a double taxation avoidance agreement, which India has signed with that country, if after that date, India signs any double taxation avoidance agreement with another country, which is a member of OECD, and that treaty provides for any beneficial rate or a restrictive scope for taxation with respect to dividends, interest, or royalty, then the similar benefit, which is the benefit of lower rate or restricted scope, needs to be provided by India to the first country. So that is the provision under some treaties. Interestingly, this is a controversy, which came in the context of India-Netherlands tax treaty, where, I'm just giving you an illustration right now so that everyone is able to understand, what is the entire controversy, and then contextualize the circular which has recently been issued. The India-Netherlands tax treaty provides for a tax rate of 10% on the dividends that are paid by Indian companies to the residents of Netherlands. Of course, subject to the fact that they are beneficial owners of that dividend. Now, interestingly, there is a most favored nation clause under the India-Netherlands tax treaty as well. So if you see right at the bottom, the clause specifically states, and this is the exact clause under the treaty, which says that if after the signature of the India-Netherlands tax treaty, India signs an agreement with another country, which is a member of the OECD, India should limit its taxation at source on dividend, interest, or royalties to a lower rate or a lower scope, as and from the date on which the relevant agreement between India enters into force with the third country. So that is where the treaty language has been provided under the India-Netherlands treaty. Now, interestingly, what has happened is that when we look at some treaties which India has signed after the signatures of India-Netherlands tax treaty, India has signed treaties with countries like Slovenia, Colombia, Lithuania. These are some countries where a lower rate of 5% has been provided for dividend taxation. Of course, they're subject to certain conditions which are attached to it. The question which is important to understand, and that's where the controversy arose, was whether the most favored nation clause under the Netherlands treaty can therefore be applied, and the rate of 5% can be claimed with respect to dividends that India has paid to non-residents who are residents of Netherlands. Now let's look at some of the relevant facts which were important in the context of India-Netherlands treaty. When we look at some of these countries, whether it's Lithuania, Slovenia, or others, at the time when the agreement between India and these countries was signed, these countries were not members of OECD. Having said that, they became members of the OECD after the signing of the double taxation avoidance agreement. But at the time when a dividend was distributed by an Indian company to a Netherlands shareholder, let's say, 1st of April of 22, these countries were residents, were members of the OECD. And therefore, the question which was important to understand was that whether when we apply this clause of most favored nation clause at the time when the dividend is being distributed to the resident of Netherlands, can this 5% beneficial rate be applied? I'll park this question because this issue, was looked at, was deliberated before certain courts, particularly in the context of Netherlands Treaty and Delhi High Court, came out with a decision upholding the issue in favor of the taxpayer that the 5% rate can be applied, under the India-Netherlands Treaty, applying this principle. Now, when we look at, certain countries like Netherlands, this issue is relevant in other treaties as well, but particularly when we look at Netherlands, Netherlands also came out with a decree or a notification, which was a unilateral decree, where it said that since, Slovenia has become the member of the OECD country, under which a 5% rate has been applied, under the India-Netherlands Treaty, the lower rate of 5% can be applied. So they came out with their own decree pursuant to the signing of the Slovenia Treaty. And they specifically brought out this point that even though it became the member of the OECD country at a later date, this 5% rate can be applied. Now let's look at, what does this, clarification or the circular which has been issued by the CBDT talks about. And this is a CBDT circular which was issued on 3rd of February, where CBDT has gone ahead and clarified the department's position on applying the most favored nation clause. While we look at some of the conditions which have been brought out by the CBDT, the fact that India should have signed treaty with a providing for a lower rate or a restricted scope, after the entry into force of the agreement with a particular country, is one of the conditions. Interestingly, they have brought out, two interesting aspects. One, that the third country should be an OECD member country at the time of signing of its treaty with India. So if you look at going back to the original, fact pattern that I mentioned, the original fact pattern, brought out one fact that treaties like Slovenia, Lithuania, at the time when India signed the agreement with these countries, they were not OECD member countries. This circular clarifies that India's position or department's position is that for this 5% rate to be applied, the third country, which is Lithuania, an example, or Slovenia, an example, has to be the OECD member country at the time when India signed the treaty with that country. So that's one aspect which is very important to understand. The second interesting aspect that this circular has brought out is that a unilateral act by a government to ratify a 5% rate under the treaty will not be sufficient. India needs to issue a separate notification for importing the favorable benefits of that treaty into the original treaty in our context of our example, India-Netherlands Treaty. Now, what does it really mean from a company's point of view? Again, as we know, circulars are binding on the department. So this is a circular which necessarily will be looked at by the department while they look at taxation of non-residents, or while they look at the applicability of withholding tax on payments being made by an Indian resident to non-residents where this treaty benefit is being applied. So they would want to apply this on their own. The issue for companies distributing the dividend and repatriating their dividend, or for non-residents which are receiving this income, is what is a better interpretation considering the decisions of the courts which had already been given, which is another one aspect that needs to be looked at. The second element, which also becomes equally important, is as part of the circular, what has been clarified by the CBDT is that this circular will not be applicable to those taxpayers in whose cases favorable decision has already been given by the courts. So assuming that this issue has traveled to a court in case of a specific taxpayer and the jurisdictional high court has given a favorable ruling upholding the applicability of 5%, in those cases, department would respect that ruling to that extent and give that benefit of 5%. So that is what appears to be the intent of this circular, but it is extremely important to consider the impact of this as Indian companies look at distributing dividends to non-residents where this clause becomes relevant, and the positions that needs to be taken in the context of withholding as well as filing of the tax returns in case of non-residents where this clause is relevant. So this is something which I thought, since it's a very recent development, it's important to share that and its impact with all of you. I'll now move to some of the important initiatives or important announcements that came in, which are relevant for companies coming in from the recent finance bill of 22, which the finance minister has recently pronounced. The first one, which is important, is to look at again the taxation of dividend income, which has been received from the foreign subsidiaries or foreign companies by the Indian companies. Again, the relevance of this, it comes from the fact that the DDT regime was done away with in Finance Act of 20, bringing in the taxation in the hands of the shareholders for the dividend income that they receive. So there was some level of misalignment when it comes to taxation of dividend income, which Indian companies were receiving from Indian companies vis-a-vis what they were receiving from foreign companies. Now, what they have brought in is that this concessional rate of 15%, which was applicable for dividends received from foreign companies, will be done away with, and the same rate of taxation would apply for all Indian companies, whether the dividend received from Indian companies or foreign companies. And this is applicable with effect from assessment year 23-24, which is financial year 22-23. Again, the other announcement, which is very, very interesting, which has brought in a lot of discussion, lot of debate in the professional world, including the corporate world, is the recent introduction of withholding tax on benefit or perquisites, which are arising on account of business and profession which has been carried out. Now, the genesis of this, if you look at the genesis of this, is looking at the provisions of Section 28(4) of the Income Tax Act, which specifically provides that if there is any value, or benefit or a perquisite, whether it is convertible in money form or not, which is arising from undertaking any business or profession, that is considered as a taxable income in the hands of the recipient. Now, when we look at when the finance minister gave her speech, interestingly, she brought out this point that when we look at how some of these benefits and perquisites are being reported by companies, unfortunately, the concern that was raised was that some of these benefits and perquisites are not appropriately disclosed and offered to tax, by companies who are receiving these, whether it is received in monetary or non-monetary form. Now, in order to ensure that some of these are getting covered within the taxation net, there is a proposal now to introduce withholding tax on these payments. A 10% withholding tax would be required to be withheld by the person who is providing this benefit or perquisite. And interestingly, when we look at the value or the threshold, the value and threshold is 20,000 rupees in each financial year. Any benefit or perquisite which is above this threshold would attract this 10% tax. Now, when this announcement was made, this was made more in the context of pharma companies. But when we look at applicability of this TDS provisions, one would note that this benefits and perquisites which are provided, they are pretty much prevalent across multiple sectors and not necessarily in the pharma sector. We will find these kind of benefits which are coming in the context of distributor arrangements, in the case of channel partners. Many such benefits in monetary and non-monetary terms are being given. And therefore, bringing in additional level of compliance for the payers to make sure that these withholding taxes are done at this rate of 10%. What is also coming out from the initial reading of some of these provisions is a larger question on whether there is a possibility of claiming any lower deduction order or a nil withholding order in case this TDS becomes applicable. Whether it is possible is an option for the recipient is a larger question, because it's basis the current reading of the language, it appears to be a challenge. It effectively means that there could be cash flow impact which can come in on companies who are receiving this value or benefit in monetary or non-monetary terms. And interestingly, where such benefit is provided in the form of non-monetary benefits, how would a withholding tax be done? And how would the payer withhold that tax and pay to the government treasury, and therefore the cash implications which will come in on the deductor? So these are very important aspects that one may need to see while we look at the TDS compliance and also the impact in the hands of the recipient from a cash tax point of view. Of course, this amendment is going to be effective from 1st of July of 22. So I'll move to the other ones, and I'm being mindful of time as well. So I'll be moving quickly from now. Now, if we look at moving to the next interesting development, which is again a very landmark development, at least in the Indian context, looking at introduction of a taxation regime for cryptocurrencies. The background, we all are aware, there is always, until now, the regulatory uncertainty on validity or legality of cryptocurrency and related assets and other related tokens still continues to remain open. The RBI, the draft bill that the government was wanting to look at for banning of cryptocurrencies yet to be tabled. RBI is yet to come up with a very clear guidelines around this, which we have, which we're still awaiting. Interestingly, while the finance minister, brought in, an element of certainty, or brought in the element that Indian rupee will be, now digitized, and that's something which has been, brought in the speech as well, and RBI is going to regulate that. And no specific mention as such on how the regulatory regime would look like for cryptocurrencies and crypto assets. When we look at taxation of these assets, when we look at what has been done till date by governments outside of India, we look at countries like US, UK, Singapore, Australia. Some of these countries have brought in guidelines on taxation of cryptocurrency assets. OECD has also issued a recent report where they have also outlined the taxation regime which has been brought in on taxation of cryptocurrencies across 50 countries. So that exists. But there are other assets like, non-fungible tokens, slightly different from cryptocurrencies and works in a slightly different manner. Again, while, when we look at countries like Australia, they, in their taxation regime, have considered NFTs to be, taxed on the same basis as, cryptocurrencies. But some countries like Romania brought out a difference, and look, they are looking at taxation of NFTs slightly different. They're talking about taxation of non-fungible tokens on the basis of how the underlying regulations look at taxing NFTs. If there's an underlying asset that has been, deployed, what is the taxation of the underlying asset, and the NFTs taxation would be on the same basis as the underlying asset. So that's, the international, background, or how countries outside of India have looked at taxation of crypto assets. When we look at what has been brought out now by the finance minister, in terms of taxation of cryptocurrencies, all income which is arising in the hands on account of virtual digital assets, which is has been defined under the regulations, which covers cryptocurrencies, NFTs, and any other assets which will be specifically notified by the government. So they have defined virtual digital assets, effectively meaning that cryptocurrencies and NFTs would be taxed on the same basis under the Indian tax regulations. Taxation is at the rate of 30%. They have provided for a mechanism in which the computation of virtual digital assets, would be done for transfer of any digital asset. Of course, they're talking about the cost of acquisition, which will be allowed as deduction, but no other deduction is otherwise permitted. A very significant element that loss on transfer of any virtual digital assets will not be allowed to be set off or carried forward, which is very clearly been articulated in the draft regulations now, as per the bill. When we look at gift of these assets, again, the gift of the assets of digital assets have also been considered taxable in the hands of the recipient. An amendment to that effect has been brought in under Section 56. In addition, they have also brought in a withholding tax of 1%, which has also been introduced. It's applicable with effect from 1st of July of 22 on transfer of any consideration payable or paid to any resident on account of virtual digital assets, under the current regulations. Again, given the fact that these are cryptocurrencies or NFTs, there could be consideration which could be paid wholly in or partly in kind, or in exchange of any other virtual digital asset. But the TDS would be applicable irrespective of how the consideration is paid. Now, this is something again which will create challenges, and one needs to look at how the consideration with respect to TDS obligation would be discharged, given that it is also applicable on consideration other than kind, which also needs to be discharged by way of TDS. If there's a TDS obligation under, let's say, 194O, which is applicable for e-commerce operators, which exist under 194O, this provision would override that, and to that extent, withholding tax at 1% needs to be applicable in this case. Now let's move forward. To look at some of the other critical amendments. When we look at eligible startups, the exemption on profit-linked exemption that was otherwise available, again, they have extended by another year to 31st of March 23, effectively because of startups who were not able to commence operations. They have extended this by another year. Similarly, for date of commencement for manufacturing or production, where the concession rate of 15% was applicable on domestic companies. Again, the period for commencing the manufacturing or production, the threshold was earlier 31st March 23. Again, that has been extended by another year to help really augment the entire manufacturing base and companies coming in and taking this benefit of this regime. In terms of capping the surcharge and long-term capital gains, earlier the capping was available, or 15% was available only with respect to listed securities. With this finance bill, this is now being extended with respect to long-term capital assets, even with respect to unlisted securities, and 15% capping would now be available. If we now move to the other measures which have come in, again, this is fairly interesting that when we look at updated tax returns, in the current regime, we have the ability to file the revised return. So if I just want to contextualize this in the context of financial year 22-23, for which the tax returns need to be filed, the original return is required to be filed, let's say on 31st of October of 23, where tax audit is applicable, or 30th of November in case where transfer pricing provisions are applicable. The due date for filing the revised returns is 31st of December, effectively giving only 2 months time in case where tax audit is applicable, and 1 month time in case where the transfer pricing provisions are applicable to the taxpayers to revise the returns. Now, the context of this amendment which has been brought in by the Honorable Finance Minister goes to the fact that there are when you look at how the government is today looking at tracking, monitoring data from multiple sources, which is now coming in, which has, the data comes in from banks, from financial institutions, from vendors, from customers, and they have that repository of information. They're able to capture a lot of data points, and they believe that, they should provide taxpayers the ability to disclose any part of the income which remains undisclosed due to lack of awareness, and give this extended window of 24 months to taxpayers to file their updated tax return. Interestingly, while this window has been extended to 24 months, what has been provided is that this updated tax return, if it is filed within 12 months, additional tax of 25% needs to be paid on the aggregate tax and interest which is payable on that, in the updated return. And if it goes beyond 12 months, additional tax of 50% is required to be paid. There are certain, limitations which have been attached to this. The limitations effectively, cover aspects where, if the return, updated return results into a loss or decreases the tax liability of the taxpayer, or if it results in a refund or increases the refund of the taxpayer, or if there's any search or survey proceedings, and where any kind of an assessment or reassessment has either been initiated, which is pending, or has been completed. In these cases, the updated return option cannot be exercised by the taxpayers. So that's really the limitation under that. Of course, it brings out many questions which are now, open in terms of how, genuine omissions or misstatements would be looked at, and whether this window would otherwise be available. And if this window is availed, does it mean additional tax need to be paid? So many questions still remain unanswered and require a deeper consideration, around this provision. Moving forward, again, these are measures which are, intended to reduce litigation. While there were provisions earlier, which were there under the, existing Finance Act, in terms of options to the taxpayer as well as the, department for not filing the appeals in case a question law is pending. There were certain, limitations which were attached, particularly in the context of appeals to be filed by the department, and it only covered cases which were pending before Supreme Court. Now, by virtue of this amendment which has been brought in, department now can look at deferring the filing of appeals in case of a taxpayer, where the department believes there's a question of law in case of a particular taxpayer, a similar question of law is, already pending before the High Court or the Supreme Court. Of course, there's a procedure which has been prescribed, which requires a prior consent that needs to also come in from the taxpayer. And once that consent is received, there's an option for the department not to file an appeal against that issue. But of course, if the consent is not received, they would go ahead and file the appeal before the respective high courts or tribunal. Looking at deductibility of surcharge and cess, of course, there were some decisions which came in the context of whether the additional surcharge and cess which has been paid by the taxpayer can be claimed as a deduction. This was in the case of Cessa Goa and others where this discussion came up, and it was held that this deduction can be claimed, and many companies went ahead and revised their returns and claimed that as a deduction. This amendment has now been brought in where under section provision section 40, and there this has been clarified that surcharge and cess is effectively in the nature of tax, relying on the decisions of the Supreme Court, where a similar principle has been upheld, and it has been clarified that this deduction cannot be claimed, and this takes a retrospective effect from 1st of April of 2005. Therefore, every company who's claimed this deduction or revised their return to claim this needs to revisit their positions on what they would want to do now with respect to these changes which have been brought in. Other rationalization measures very quickly. Non-filers, there was a provision that if the payment is being made to a person who has not filed the return in the last 2 years, tax TDS would be done at twice the applicable rate. To make it more stringent, this requirement of 2 years has now been reduced to 1 year. Now, if a recipient has not filed the return for the last year, the higher rate would now be applicable, and therefore requires a careful consideration for all TDS compliances that now needs to be done. Again, these next two provisions are more in the context of reorganization. There were many challenges which were being faced by companies who were going through mergers, amalgamations, demergers, and there was a controversy in terms of validity of the proceedings, which the department has done, while these, final order from the NCLT or the applicable authority has not been passed, and that has now been given some level of validity by virtue of these provisions, which have been introduced by the finance minister, providing that any proceedings which are pending or completed on the predecessor entity during the pendency of the application before the applicable authority shall be deemed to be applicable on the successor. So that is a aspect that has been brought in. When it comes to, again, window for filing the modified return, again, this was a bigger issue. There were Supreme Court decisions, Marshall and Sons. There was Supreme Court, another decision in case of Dalmia Cement, which was there, which taxpayers were availing, to make sure that upon the order of the NCLT and applicable authority, confirming the business reorganization or restructuring, they are able to file the modified returns, giving effect to the order of the courts. But of course, there were huge delays in terms of the appointed date of the reorg and the date of filing, and by when the time limits for filing the returns or revised return would have already expired. This provision now just brings in clarity that the successor entity can file the modified return within 6 months from the end of the month in which the competent authority issues the order. Interestingly, where some part of it still remains open, that if the reorganization requires the return to be filed both by the successor and the predecessor, which could be a relevant case in case of demergers, kind of a transaction. Those taxpayers, particularly the predecessor, would still need to rely on the decisions of the, Marshall and Sons and Dalmia Cements and others. And this provision may not technically legally apply to them. And therefore, larger question on how the government is going to enable the filing window for predecessors to modify their returns. So that's a question that still remains unanswered. Of course, this amendment is again going to be applicable from April 1, 22. when we look at deduction with respect to expenses under Section 37(1), again, there were many disputes in the context of, particularly in the context of pharma industry on, how the deduction for these expenses, which involve providing freebies to doctors, etc., whether deductible or not. And therefore, in that context, there is, clarifications which have been brought in the context of Section 37(1), where it has been clarified that if there's an expense, which involves any sort of non-compliance under any existing provisions and law, whether in India or outside India, or involves any violation, compounding, or even in the context of recipients, which is very interesting. That one is a payment which is prohibited from a payer's point of view. The second element or second limb of this amendment even includes expenses which are prohibited from a recipient's perspective, whether in India or outside India, under any law. And the third limb, which is any compounding, which has been paid by the taxpayer in India or under foreign law. All of these three aspects, the deduction for these expenses would no longer be allowed. While it has a larger impact for pharma industry, where this is intended to be clarified, interestingly, what we need to all look at is how do we deal with certain payments which are made under different law for compounding of offenses, because there are certain decisions from different courts already on this topic, which talks about deductibility of compounding fees, since that's not in the nature of penalty. So the impact of that needs to be also considered while we look at these clarifications which have been brought in. Looking at Section 68, which is fairly onerous when it comes to taxpayers, particularly the applicability of the higher tax rate, which is applicable on adjustment which happened because of Section 68. Important point that which needs to be considered is that this provision is now become applicable for even transactions involving loans or borrowings, and it is applicable irrespective of the nature of the taxpayer, except for certain exempted categories, which includes the venture capital funds, which has been specifically exempted. Does it mean even banking institutions would need to look at this specific provision and ensure that the source of the cash or credit is explained? Basis the current reading of the provisions, it appears that it is applicable to all taxpayers, including banks and financial institutions as well. This is again fairly interesting provision. Again, the entire revamping has been done. There was a new regime which was introduced in the Finance Act of 21, which provided for reduced timelines for initiation of reassessment proceedings, which was brought down to 3 years. And 10 years was a time limit which was considered applicable under very specific cases. Now, when we look at what has been brought in the Finance Bill of 22, two elements. One, they have clarified cases where assessments can be reopened. Interestingly, we'll find that earlier the cases were restricted to very specific category of cases which were identified in the risk management system of the government of India or under the CAG objections which were there. The intent of the amendment in Finance Act 21 was more to ensure that any sort of subjectivity is removed, and it is all cases are reopened basis certain specific structured criteria which comes in from a risk management system of the department. What has been done now is that there are additional cases which includes even audit objections, which have been brought in, into the ambit, or on the basis of any information requiring any action in the consequence, as a consequence of any tribunal order. All those cases have also been brought in, effectively meaning that the standardized approach that they were wanting to take and was expected in Finance Act 21 is probably now changing to also include audit objections, which is, based on the internal audit of the department and their files. The other important element, which is, worth noting, because this will have implications from taxpayers' point of view, is, looking at the enhanced, scope of cases which can be, included within the purview of reassessment under the larger time limit of 10 years. And this is important to look at, because now when we look at the cases which have come in, which has been listed, unlike the earlier definition which covered only underlying assets, category of expenses in respect of a transaction, or in relation to any expenditure in the event of any occasion, or entries in the books of accounts. These categories have also been added to cases where a potential larger or a wider time limit of 10 years can be applied. Now, these are, by virtue of its plain simple reading, seems to be fairly large and wide in its ambit, and therefore requires, gives probably additional occasions for the department to look at reopening assessments within the larger time limit of 10 years. And therefore, how this will be applied in the context of taxpayers by the income tax department needs to be seen. Interestingly, the other point which we also observed, it's important to see, still it requires a more careful analysis and coming out with a conclusion, is when you look at the time, threshold of 50 lakhs, earlier the threshold of 50 lakhs, there was an explicit language which said 50 lakhs for that year. Interestingly, that language of 50 lakhs for that year, has been removed from the amended definition, and therefore bringing a larger question whether the attempt can also be to look at a cumulative impact on account of income escaping assessment, which is 50 lakhs across years, as against 50 lakh for a specific year. So it's a finer point, but of course requires a careful review, and also how this will be viewed by the tax authorities as we go through the course of the year, where these provisions may need to be applied. So these were some quick summary of some of the changes which have been introduced, which could by the finance bill of 22 may having an impact for companies, and that's quickly a summary. If there are any questions from any one of you, happy to take them and provide clarifications.
Ma'am, there are two questions for you. One question is relating to what option left with resident SSC in case of ITO has disallowed the tax credit for the tax paid in the countries under DTAA in the ground of filing Form 67 after the due date under Section 139(1). This is just a procedural flaws, and how Rules 128 can override the provisions of DTAA.
So, it's a debatable question, but yes, this issue has been looked at by certain courts, and there are judicial precedents which are available on this topic. And interestingly, when we look at some of these judicial decisions, it does permit the taxpayers to look at filing these returns even when the time period has for filing this form has elapsed. So there are judicial guidance which is already available, and to that extent the taxpayers can take that benefit. Of course, having said that, since this is a debatable point, the litigation on this topic for taxpayers will always be a point that they need to consider, but guidance is available on this topic.
Thank you, ma'am. One more question that is very elaborative question. Let me explain you the question. The client has linked the vendor import payments with its credit card, and the payments are automatically getting debited from the credit card. And the client comes to know about the payments only at the month end when the credit card statement report is obtained. The client now wants to regularize the earlier defaults of non-filing Form 15CA for the financial year 21-22 in respect of such transaction by filing belated forms. However, on the IT portal of the time of filing the Form 15CA, the system is only giving option for either the current date or the future date under the column proposed date of remittance. Kindly advise how can the earlier defaults of non-filing of Form 15CA be made good? It's just a practical question relating to the filing of this.
So again, I mean, this is, not really a legal question. Unfortunately, it's more a, challenge from a operational point of view. And these are issues which most of the taxpayers, many taxpayers are facing, with the online filing facilities which are there. And this enablement is today not there in terms of how to amend the prior Form 15 CAs. What I would as a practicing CA would still recommend that if there is a need for this kind of a correction, which one is not able to do online because the online facility is not today providing this kind of a option to the taxpayers. A physical amended 15 CA is filed with the relevant jurisdictional tax officer. Citing that the current challenge in the online facility, and therefore at least ensuring that the current facts are submitted to the authorities, at least in the manual format, are given, and the intent to make sure that the correction is done is clearly articulated. So I think that could be at this stage the option. The other thing that we have been also looking at, and we should probably explore if this this is a challenge, making sure that a representation to that effect is also made to the government, to the CBDT, on the new online, the new portal, that if some of these functionalities can also be added. I mean, of course, there are multiple challenges, and issues which are there with the online portal, and the government is doing what they are doing at the end to make sure all these practical difficulties and challenges are removed. This could be another element that as practicing CAs, we can certainly represent to the government to make sure that as and when feasible, this is also brought in and ease the way in which reportings can be done and corrections can be made.
Yes, ma'am. Yes, ma'am. One question is relating to the budget. They are asking any deduction allowable to the senior citizen or to the individual in the direct taxation in this budget. I hope there is no such deduction or
nothing on senior citizens, but there's more emphasis in terms of COVID-related deductions which have been brought in, and brought in that level of clarity for the taxpayers who have received certain ex gratia or others on account of that.
And one member is asking, Madam, while filing the income tax return, we have to be concentrate on Form 26 AS or AIS, because annual information system is also now applicable. And last year it was not, but now the coming year it would be, because direct fetching of all the transactions to the income tax department through AIS. So we have to rely on AIS or Form 26 AS. Or if there is a lacuna or there is a gap between two, so to whom they should rely and fill their income tax return?
So it's a very, very, very interesting question. And if you look at how the new AIS has been formed, and just to quickly cover this, we should all be aware that when we look at how the department has looked at their own data now, they are collecting, as I briefly mentioned, they're collecting information from different sources now.
Yes.
Whatever is getting reported from banks, from financial institutions, from payers in the context of what they're reporting in their TDS returns, from the recipients on what they're reporting on the TCS side, all this information is now getting collected. What they are now doing is, basis that reporting, which is linked to a PAN of a taxpayer, they are creating an AIS statement, which clearly articulates this is the amount of foreign remittances you have made. This is the amount of expenses which have been reported from the payments, from the income, assuming that the TDS compliance has been done. On the TDS side, whatever the reporting has been done, this is your revenue. So they are just saying that, look, this is what under your PAN is the amount of TDS that becomes your revenue, and they're showing this as business receipts. Similarly, looking at the corresponding amount of what they have reported as expenses in their withholding tax returns to say this is the amount of business expenditure that you have. Now there will always be practically gap between what you would have as a part of your financial statements, because there will certainly be certain amount of payments which will not be liable to TDS. Of course, with TDS getting introduced on goods, which has already happened, the quantum of payment which are escaping TDS is anyways limited. And increasingly, as you see the budget announcements this year, increasingly more transactions are now coming into the TDS net. So they are able to effectively get as close to your financial statements. Of course, there'll be gaps in terms of thresholds, in terms of lower deduction certificates and deduction certificates that people may have obtained. There will be gaps in terms of provisions. There will be gap in terms of any, Ind AS and other adjustments that will happen. Now, should one rely only on 26 AS or AIS statements? The answer to that is technically, legally, no, one should not, because there will always be justifiable differences between what is there in the financial statements and what is coming in AIS. And, if you look at the construct of the AIS and TIS statement that has been, given by the department as well, there is an ability to question or challenge. You can record that, you partially accept or fully reject, along with certain reasons. Of course, this detailing will have to be done because every other operational aspect of it is not very clear today, but there are options available. And that reason for rejection, partially or fully, can be provided by the taxpayer. There is a very detailed process the government has at the back end to go and challenge the back end source from where this information is coming. So that level of validation will always happen. My limited answer to that would be that one may not necessarily need to rely entirely on that, but one should always maintain a reconciliation, which is very, very critical from this day onwards as we look at it. Reconciliation between what is getting reported in your 26 AS stroke AIS statement and what is the amount which has been reported in the financial statements and what you're reporting in your tax return. Because this kind of reconciliation would be asked by the department, going forward, and to that extent, the preparedness to, be ready to answer those questions should be there.
Because it is the wholly and solely responsibility of the taxpayer.
Absolutely.
Because whatever he has received during the year, and it is his responsibility, his or her responsibility to show in his income tax return.
Absolutely.
Whether it is reported or linked with the form 26 AS or AIS or not. Suppose take example of there are lots of changes in the bank name, like from this Vijaya Bank to the Bank of Baroda and Oriental Bank of Commerce to the this PNB. And if the taxpayer has already linked with the Vijaya Bank, so quite possible it has not yet been connected with this PNB, and uski income report nahi hui hai. So that is the responsibility of the taxpayer only to show in his income tax.
And the onus will always be the department will always put the onus on the taxpayer to explain that.
Yes. And one more question relating to the deceased assessee. If the any assessee is deceased, and it is obligatory for their descendants, or you can say her son or her daughter to surrender her PAN in case the mother is deceased. So it is necessary to inform to the income tax department that one of the assessee has deceased during last year and there is no income during that particular year, and we are surrendering her PAN or his PAN during that just to inform to the income tax department.
See, I think it's all. While there may nothing under the law which necessarily requires obligates someone to cancel the PAN, but it is generally good practice to make sure that once the person is deceased, that information is brought to the notice of the taxpayer to the department, and after due payment of taxes and returns that is required to be filed, the process of surrendering of the PAN is done. That's a best practice to have that. And if department wants to do any sort of an assessment on the last file return, they can do that and then close the process of closing the PAN.
Close. So these were the few questions for relating to the direct tax and international taxation. So thank you so much. We are come to end. This is our today's 99th VCM, as I told earlier. So successfully we have completed 99th CP program conducted by CMP of ICI for the benefit of the members. Thank you so much for sparing your valuable time. And again, thank you so much for acceding to our request on a very, very short notice. I hope only on a distance of 1 or 2 days. Thank you so much. Thank you so much.
Thank you, sir. Thank you all. Thank you.